Good afternoon, everyone, and welcome to our recording of our March edition of Lunch and Learn. The topic, Retirement Matters, an inside look at retirement living. My firm, Kaydan Wealth Management, is an independent advisory firm, and I'm Jim Cruzan, owner and branch manager. Let's talk a little bit about our firm as just background. As I said before, we're an independent registered investment advisory. We are affiliated with Raymond James. What that means is all the investment solutions, the consultations, all the advice provided is provided through Kaydan Wealth Management. Raymond James provides custodianship, safekeeping, provides statements, provides performance reporting as well. We got our start several decades ago providing thoughtful investment advice to employees of the extended automotive industry. And today, many automotive workers, those in factories as well as engineers and managers, represent a large percentage of our client base. And we provide our services at two locations. We have an office in Fenton, and we also have an office in Auburn Hills. A better idea of what we do may be found by simply focusing on our mission statement. Our single focus is to make an impactful difference in the lives of our clients and their families. As advocates, we work closely with our clients to clarify the financial landscape and successfully navigate life's most important events. To help achieve this through insightful, unbiased advice, meaningful portfolio management, and impeccable service. If you want any more information about Kaydan Wealth Management, I'd suggest you look us up at our website, kaydanwealthmanagement.com. There's a significant amount of information on there for you to browse. Let's get started. When we talk about retirement planning, and in particular what retirement living looks like, there are several major concerns, and today we're going to focus on four. We're going to talk about timing of retirement in the tale of two retirements. We'll look at briefly both Social Security and the implication of healthcare cost post-retirement. And then we'll also understand a little bit about inflation and what impacts it has on both retirement and retirement spending. And at the very end, we'll wrap it up by having a brief discussion of different distribution strategies. Let's start with the tale of two retirements. One key decision, which we do have some control over, is when we decide to retire. And obviously, if we had our choice, it would make far more sense to retire ahead of a strong market as opposed to ahead of some problematic period of time. This is a great example. Let's assume for a minute returns that look like the S&P 500. And let's assume also that an individual were to retire on $500,000. And they retired in 1991. Let's also assume that that individual decided to pull $70,000 a year out of this portfolio as living expenses. Now that $70,000 by no means is a recommendation or a suggestion. In fact, it is a significantly large distribution amount and would not be something that would normally be recommended. In this particular case, however, because the 90s were so robust, at the end of the decade, that individual now had a portfolio that was nearly $800,000, and they enjoyed a decade of upward trending income, to the extent that in 2000 they were pulling nearly $90,000 a year out. That 10-year period was certainly a success. Now let's look at the same scenario. This individual retiring just 10 years later, retiring in 2001 as opposed to 1991. And as we know, we had the dot-com bubble burst and then the short, shallow recession thereafter. And we can see with the same amount of money, $500,000, and the same distribution goals, $70,000 a year, the scenario is entirely different. In this particular case, the money completely runs out in about 7 years of retirement, and while income increased for several years of retirement, ultimately it stopped completely. Timing of the retirement decision is certainly important. Let's now look at both healthcare and Social Security, and we'll start with Social Security.
Social Security has been a fact of retirement life since 1935. But how much do you really know about it?
Here are 5 facts that might surprise you.
The Social Security Trust Fund exceeds the gross domestic product of every country in the world except the 7 largest. It's the major source of retirement income for the majority of Americans. Benefits are subject to federal income taxes, but it wasn't always that way. The 1983 amendments to the Social Security Act made benefits taxable. Benefits are determined by your average earnings during a lifetime of work based on the 35 highest years of earnings. There haven't always been cost of living adjustments. Before 1975, increasing benefits required an act of Congress. Now they can happen automatically. When should you begin taking Social Security? That may depend on several factors, but most people opted for early benefits, which can start at age 62. But there is a big difference between age 62 and age 70. You may receive over $1 million in benefits, so deciding when and how to take the income is a critical decision. Call today and schedule a review.
As you can see, the issue with respect to Social Security is extremely important. In the past, folks looked at Social Security from a break-even analysis. If I don't take it at 62 and take it later, I've lost 4 years of income. How many years do I have to live before I get it back? But life expectancies are increasing, and as such, maybe one should look at Social Security from a longevity perspective. As an example with respect to life expectancy, consider this slide. Those preparing for or in the process of preparing for retirement, 40% tend to underestimate average life expectancy. Today, a couple age 65 has at least a 50% chance that one of the two will live to age 92, and a 25% chance that one could live to 97. These are extremely long potential retirements. And because of that, we're going to have to deal with a long period of time under some form of health care. In fact, 83% of folks that are also in the process of planning for and putting together some mode of retirement planning feels like they are either not confident or only somewhat confident of what cost will be. Our friends at the Fidelity, a very large 401k and mutual fund complex, has suggested an individual will probably spend something in the order of $250,000 post-retirement for health care, all inclusive. That includes premiums, co-pays, non-reimbursable medical expenses, and other such medical expenditures. And we can kind of see why. Over the last 20 years, healthcare cost has certainly risen well beyond that of normal inflation. In fact, it has more than tripled. And part of that is the longevity issue. Let's now consider inflation and spending. You know, if healthcare is one of the single biggest post-retirement expenses, inflation is probably one of the single biggest post-retirement risks. This is a 50-year period, 1963 to 2013, and probably beyond the scope of most retirements. But if we look at that chart and we just consider certain asset categories, new homes, new cars, average income, you'll see over that 50-year period, just about every single asset category has increased by a factor of at least 10 to 1. I often will ask in a seminar situation, a room of people, how many are driving a new vehicle that costs more than their first home? And it's amazing the number of hands that raise. To deal with inflation, often people consider other alternatives in retirement. One certainly is working. Maybe someone would consider part-time work or working elsewhere beyond their primary employer. Sadly, if we look at what folks who are working consider in terms of what they'll do in retirement, and actually what retirees report they actually do, the numbers are quite a bit different. 65% of workers today expect to work for some pay in retirement, or at least partly in retirement. The reality is only 27% actually do. 42% of workers expect that their employer-paid or employer-sponsored retirement programs, 401k and such, will be enough to cover their income needs, a major source of income. The reality is only 19% of folks suggest that to be the case. And lastly, 33% of workers today report that they expect Social Security to be a major source of retirement income. In other words, they expect there will be other sources afforded to them. The reality is, retirees today, 62% of them report that it is their major source. So what we're seeing here is really a function of not saving enough or not anticipating the real expenses in retirement. One way of getting a better handle on that is to really start focusing on where one spends money. If we look at an average household with average income, you'll see housing is a major component to spending. Transportation is a major component, as is healthcare and food. In retirement, some of these categories will adjust a bit. Housing becomes less important. Mortgages are typically paid off. Healthcare becomes more important, becomes a greater percentage. Investment and pension expense drops off as there's less contribution post-retirement. It's important to focus and spend some time on your own budget. And getting a better handle on your budget is very important because when we start distributing money from a portfolio, the more we take out, the greater risk we have of consuming it before we're done with our retirement plan. Consider this graphic. Withdrawing $40,000 a year adjusted for inflation versus withdrawing $80,000 a year adjusted for inflation on a $1 million portfolio. The difference between a 4 versus an 8% distribution. The 4% distribution seems to last a very long time, whereas the 8% distribution, the likelihood is, with high percentage of probability, will run out well before retirement. Let's consider creating strategies for retirement income. The first thing we have to do is get our allocation correct. What is the appropriate mix of stocks, bonds, and cash? Once we have that, it's also important to refocus on that original allocation periodically, at least annually, and rebalance the portfolio. Rebalancing just simply means reorganize the portfolio back to the original allocation. And that's a tremendous risk reduction tool. As an example, if at retirement in the year 2000, we thought an appropriate portfolio was 60% stock, 40% bond, and now we roll ahead those 13 years, and in 2013, that portfolio is almost flipped around. Bonds represent in excess of 50% of the portfolio, and stocks less than 50%. So at that point, the portfolio doesn't have quite the stock allocation that originally was requested. And more importantly, today, it's carrying a lot more fixed income, which could mean that it's carrying a lot more interest rate or credit risk. It's important to review and rebalance regularly. Now let's also look at where money is today. What are the buckets of money that we have? Investment, IRA, 401k. In our practice, we try to make sure that we have tax diversity. It's important to have money in qualified tax-deferred assets, IRAs, 401ks, and such. But it's also important to have money in a tax-free bucket or a tax-preferred bucket so that as we distribute monies from a portfolio and kind of turn that spigot on, we have a few choices as to where to harvest this income from. Because retirement is all about converting the growth strategy or the growth plan into an income plan. And when we're creating an income plan, it's important to look at efficiencies, and in particular tax efficiencies. There are a couple different ways to structure a portfolio. One of the more popular ways is some type of a bucket strategy. Now this chart discusses an annuity strategy, but the term annuity in this case is really just being used as a block of money upon which one is receiving some kind of income. It does not have to be an annuity as in an annuity product offered through an insurance company. So in this case, what is happening is the block of assets is being split amongst two separate buckets. So this would be a two-bucket strategy. One bucket the $129,000, will provide the $1,253 a month that we need for an extended period of time. That will last approximately 10 years. That leaves the second bucket, $270,000, to allow it to grow unencumbered for a period of 10 or more years, at which time a part of that money will then be removed to create the income stream to carry it out the next 10 years or more. And by doing this, it allows some degree of comfort when the markets become a little bit volatile. A more popular strategy is using a three-pool or a three-bucket strategy, where we make sure that we harvest enough money to cover 3 to 5 years of cash flow, and that'll be put somewhere that is extremely safe and secure. The next bucket will provide intermediary funding from years 5 through 10 or 15. And then the last bucket, we really don't turn that spigot on until much later down the road, 10 or 15 years further down the road. That last bucket essentially is much more growth oriented, whereas the other two are much more conservative or moderate in their focus. There are a lot of different things to consider when considering a retirement plan, and especially when considering an efficient way to create cash flow post-retirement. So it makes some sense to maybe spend some time with a trusted, knowledgeable advisor. So let's talk for a minute about why we might want to consider using an advisor. The biggest reason is this whole idea of retirement planning. It isn't easy. Success is driven by a clearly defined process. The folks at Vanguard, a large investment complex, issued a white paper back in 2014 talking about the value that an advisor may be able to provide a client over an extended period of time, over a business cycle. And the folks at Vanguard suggested that a competent wealth advisor can add as much as 3 or more % a year to the portfolio value, to the relationship. Not by beating the market at 3% a year, but rather by offering advice and other wealth management strategies. For example, rebalancing a portfolio on a regular basis and other things that could be done to a portfolio may in fact improve the return by as much as 1 or more %. Wealth management, that is offering advice on Roth IRAs, finding ways to construct the portfolio more tax efficiently, providing advice on a variety of wealth management solutions, can improve the wealth building process by as much as 1% or more a year. And the last category, the one that provided the biggest amount of potential improvement, is behavioral coaching. That is, making sure that the client understands why the plan is the way it is, and make sure that you have the staying power to stick it out. Without that, often one becomes prey to one's own emotions, and we know what happens then. We're forced to sell out at much, much lower prices at a time when hindsight would suggest we shouldn't have. And then once we're out, we need a tremendous amount of validation before we feel comfortable getting back in. And doing that over 1 or more business cycles can severely compromise one's overall long-term return. So whether you have an advisor or go it alone, why not consider a second opinion? In our firm, we provide second opinions, and they are in the form of a discovery interview, analysis, and the delivery of our capabilities report. Our discovery interview, we will sit down with you. We will discuss your goals, your likes, your dislikes, fears, and concerns, and we'll gather all the important information. We will then do analysis. We'll conduct risk analysis. We'll look at the portfolio in conjunction with your retirement goals and objectives and see what the probability of success would be. We'll look at the current portfolio's level of risk, and depending on the amount of data that we collect, we can do somewhat a forensic review, look at cost, look at liquidity, look at tax diversity as well. Then we'll get together a second time and we'll deliver our capabilities report. We'll discuss what was discussed during our discovery interview. We'll talk about the analytics. We'll talk about the overview, objectives, our observations, and also specific recommendations. But more importantly, you'll leave with a clear vision of what working with us would look like, what our processes are, what meetings would look like, what kind of communication you can expect, and the various levels of service and pricing. Again, if you're interested in developing a relationship with a wealth management firm that provides an impactful difference in both clients and their families, help navigate life's most important events, and provide unbiased, meaningful portfolio management and impeccable service, why not consider our second opinion? At my firm, we have no minimums, we're very scalable, we're predominantly fee-based, and we have multiple service levels. With that in mind, thank you so much for hearing the recording, and we hope to hear from some of you in the future. And once again, visit us at KaydanWealthManagement.com. Thank you very much.